Today, Bitcoin recovers some of yesterday's losses. KBW raises its price target on Coinbase, but still sees regulatory headwinds for the crypto exchange. And Custodia CEO Caitlin Long discusses what's next for the bank after a federal judge dismissed its lawsuit against the Fed. Crypto World, I'm Brandon Gomez. Bitcoin and Ether are bouncing back from yesterday's sell-off. By noon Eastern, Bitcoin rose 1.5% to the $65,000 level. Ether jumped 2.7% to $33.30, and Solana soared 6.5% to $189. Okay, let's talk about the top stories. ARK Invest's Cathie Wood joined CNBC's Squawk Box earlier this morning to discuss the recent moves in Bitcoin. Now, when asked about its correlation with US Fed policy and markets, she emphasized that investors outside the US are turning to Bitcoin due to devaluation of their local currencies.
There are currency devaluations taking place that people are not talking about. The Nigerian naira is down 50-60% in the last 9 months. Egypt just devalued by 40%. Argentina continuing to devalue. I think this is a flight to safety, believe it or not, taking place. A hedge against devaluation, a hedge against a loss of purchasing power and wealth. That's very important. And we saw this even here last year in the United States. Regional banks imploded. Bitcoin went up 40%.
Meanwhile, ARK Invest's spot Bitcoin ETF in partnership with 21 Shares has seen a wave of outflows in recent days. According to Farside Investors, the ARK B fund saw more than $87 million in outflows on Tuesday, surpassing the Grayscale Bitcoin Trust. Next, KBW raised its price target for Coinbase to $230 from $160. Now, this new target is still below what the stock is trading at today as of noon Eastern, but the more optimistic sentiment is a result of surging volume in Q1 and growing USDC balances. Coinbase saw an average daily volume of $5.1 billion in March, up more than double from $2.4 billion in February. Still, the report pointed to risks tied to Coinbase's revenue, which is highly correlated with crypto markets. KBW thinks that could lead to trouble in the event of adverse regulation for the crypto industry. The report also predicts a long-term risk of fee compression. Now, that said, Coinbase shares have jumped more than 40% so far this year. All right, for our main story, Crypto World's Jordan Smith spoke with Caitlin Long, founder and CEO of Custodia Bank. She discussed the next steps for the bank after a judge dismissed its lawsuit against the Fed, also giving her outlook on the crypto industry for 2024.
Caitlin, thank you so much for being here. I want to start right off the top with this ruling that we got earlier this week, a federal judge dismissing your challenge to the Fed Bank of Kansas City's denial of a master account. This is something that Custodia has been pushing for some time. Can I ask what the next steps are in this decision? And is there an appeal in the works? And what's the plan for Custodia going forward?
Well, we are considering appeal. We did say that right after the news was announced. And our Bitcoin custody business is unaffected. And we're still in the US dollar banking business through partner banks. Obviously, we've had one hand tied behind our back, or arguably two hands tied behind our back, because unfairly and illegally, in my view, we've not been able to get a master account, but this is not over yet.
Yeah. Just so people are aware, can you talk about what the benefit of a master account would be for Custodia? You mentioned that you have partner banks right now. You are still operating as a business. This hasn't hindered your ability to operate so far, but how would a master account change your business compared to how it operates right now?
Yeah, this is what's relevant to the Bitcoin market in particular. Bitcoin and crypto generally trade 24/7, 365, but FedWire does not. And so what that means is there's a mismatch in timing of settlement between crypto and US dollars. And that in a way, if you step back, the foreign exchange market has continuous linked settlement. It's literally called CLS Bank for foreign exchange markets. And in the Bitcoin world, Signature and Silvergate created what was effectively a private CLS bank with their Signet and Sen networks that allowed customers to, through internal transfers just on those individual banks' ledgers, to settle US dollars 24/7, 365. And so you could have a continuous linked settlement between US dollars and Bitcoin. That when those banks failed, which they deserved to fail, they were holding only 10 cents of cash against demand deposits that could disappear within the span of hours. the bank regulators suicided those networks. And it was a mistake because now there is no way to settle US dollars 24/7, 365 in size. There are one or two small banks still doing it in small size. But now here come the Bitcoin ETFs, where you've actually got a lot more volume of US dollars and a lot more trading volume in Bitcoin happening after Fedwire hours. And what that means is that all those unsettled transactions are just piling up. It's called Herstatt risk for people who are familiar with the foreign exchange market. And when Herstatt Bank failed back in the 70s, it created cascading defaults. And CLS Bank was the answer to that. Well, the Bitcoin world had our private versions of that. And bank regulators just didn't want them to exist. But now, by having Sen and Signet suicided and Custodia iced, what that means is that risk is not manageable. And moreover, it's sitting in the global systemically important banks because they're the clearing banks for the Bitcoin ETFs.
While I have you, I want to move outside of just this lawsuit and talk about crypto more broadly and specifically about Bitcoin. These ETFs are seeing huge uptake. And as someone who is a veteran of Wall Street, I'm just curious for your reaction to the embrace of these ETFs, for one, and whether you feel they're complementary to Bitcoin and its sort of thesis as an asset, or whether they're opposite of the vision for Bitcoin.
Well, I've always said that Bitcoin ETFs are a double-edged sword. I started writing about that back in 2018 for Forbes when I saw this train coming and saw mainstream Wall Street institutions get into Bitcoin. And why are they a double-edged sword? Clearly, they bring a new pipe for demand, a very wide pipe for demand, because it's just frankly easier and folks, are comfortable buying financial assets through their brokerage accounts. And registered investment advisors in particular have an incentive to help customers who are interested in buying Bitcoin to buy it in that format, an ETF. The problem that's the other side of the sword is that all the Wall Street leverage games start getting played. Now, I do take my hat off to the SEC because they did something right here. I've been very critical of them in other contexts, but here, very praising. They prohibited the ETF issuers from being allowed to rehypothecate the underlying Bitcoin collateral. Good for them, because that means some of the leverage games that Wall Street plays cannot be played on these Bitcoin ETFs, unlike the underlying collateral in other Bitcoin ETFs, which can be rehypothecated. So there isn't going to be hidden leverage, assuming the issuers actually comply, which I assume they will. But the other piece of it, though, is that the leverage can be piled on top of the layers, and it will. So the ETFs, of course, can be leveraged, just like any other security. They can be rehypothecated. You can borrow against them in your margin account, etc. And once you start doing that, you start to get the commingling and substitution of collateral. That's where the leverage can start to get out of control. And as we've seen, Bitcoin in the last cycle had a lot of credit losses as leveraged Bitcoin lenders blew up. I've been attributed the phrase, a fool and his leveraged Bitcoin are soon parted. And I do believe that that's true. And we're going to see leveraged Bitcoin ETFs now. Again, Wall Street has some important lessons to learn here that Bitcoin's a different animal. There isn't anyone who's going to be able to create more of it. There are no clearinghouses like there are for other types of financial assets. And so if someone gets themselves net short on actual underlying Bitcoin, and there is a short squeeze, it's going to be ugly for them. And I worry because the risk systems of traditional finance, like we talked about the Herstatt risk on the US dollar piece earlier, they're not set up for something that settles so fast. There are so many in the security side of Wall Street, so many fault tolerances for operational risk, for failures to deliver, etc. There is no such fault tolerance in Bitcoin.
This may seem like quite the tonal shift, but I am curious, what most excites you about crypto in 2024? It feels like the energy is back for the space and we're hitting new all-time highs for Bitcoin. What are you watching that's got your attention on a positive note?
Well, the demand coming from the ETFs. The wirehouses aren't here yet. So we've seen this first big wave. And obviously we had more selling from the grayscale, from the bankruptcies and the like. We're not entirely through that yet. So it's been a bumpy ride. But the halving's coming, and the Bitcoin ETFs demand in that, I think it's going to be spectacular. And I wouldn't be surprised to see a pullback in the price, as is usually the case after the halving. There will be a number of miners whose mining facilities become unprofitable. The hash rate will dip as those miners shut off their unprofitable machines. And then there'll be a J curve. And then the price will rally again. If past is prologue, that'll start later this fall. And we will be, I think, if past is prologue, and I think there's a pretty high probability this is exactly how it plays out. The punchline is we will be in a rip-roaring bull market around the time of the U.S. presidential election. And I think it's going to be very ironic that this Biden-Warren crowd has been so anti-Bitcoin, because it might just be in a rip-roaring rally right in their faces at the time of the election.
Back here again tomorrow.